Morning everyone, welcome to Ainsley News, talking crypto today of course, Crypto Tuesday. Just after Valentine's Day, hopefully everyone's recovered. Crypto market opts for safety. Bitcoin investors have de-risked as global macro headwinds increase. In particular, traders have eyed the proposed Fed rate hikes in March, opting for protective insurance over speculative calls. Bitcoin market continues to grapple with numerous macro headwinds from the tightening of Fed policy expected in March and now fears of a potential conflict escalation in Ukraine. This week has seen Bitcoin derivatives markets pricing in this uncertainty with a flattening out of the futures term structure curve until March. Futures premiums out to the end of 2022 are notably low, trading at just 6% annualized, and the market is expressing a strong preference for protective put options. Simultaneously, on-chain supply dynamics are remarkably stable, a likely indication that investors are prepared to ride out whatever storm lies ahead, preferring to utilise derivatives to hedge out risks. Overall, this speaks to the continuing maturation of the Bitcoin market as liquidity deepens and more comprehensive risk management instruments become available. This differs greatly in comparison to historical Bitcoin market cycles, where de-risking was possible only by the sale of coins in spot markets. Quite to the contrary, current spot holdings and flows on-chain continue to display to be constructive characteristics rather than a mass exit driven by fear or panic. As Bitcoin derivative markets mature and liquidity deepens as well, we can draw increasingly useful information from futures and options pricing. Across all the exchanges, the futures term structure has flattened out through to March, equivalent with expected rate hikes proposed by the Fed Reserve. This speaks to a clear investor uncertainty regarding the wider economic impact of the tighter US dollar, given the preceding decades of loose monetary policy. Futures out to the end of 22 are currently trading with a very modest annualized premium, suggesting that the market is quite far from anticipating a wild bullish impulse anytime soon. There has been also a notable deleveraging across futures markets this week. However, not as a result of the infamous liquidation cascade that punctuated so many moments in 2021. The primary driver appears to be traders opting to close out their futures positions, rather than a forced sale or bid due to liquidations and volatile pricing. The market appears to be de-risking and curtailing leverage in response to a plethora of macro uncertainties. In other words, people are pulling out of leverage positions, not knowing what's coming next. Total futures open interest has now declined from 2% to 1.76% of the market cap. Relative leverage of this magnitude has shown to be considerably more stable range for the market through 2021 and was last reached after the 4th of December 2021 deleveraging event. Investor de-risking in prior Bitcoin market cycles was best expressed by the sale of coins in spot markets as investors reduce their exposure. In this instance, we would usually expect to see a period of net coin inflows to exchanges, a phenomenon that was observed from May to July 2021. However, in the current market, we continue to see net coin outflows as a non-trivial rate. Across all exchanges, BTC is flowing out of reserves and into investor wallets at a rate of 42,900 BTC per month. This trend of net outflows has now been sustained for around 3 weeks, supporting the current price bounce from the recent 33.5 thousand US dollar lows. Long-term holder supply has continued to hold a sideways trend, with a total supply held of around 13.341 million BTC. There is almost always a consistent flow of coins maturing from short to long-term holder status. As such, this indicates that the degree of long-term holder spending is approximately equal and opposite to the degree of coin maturation. Since October, all-time high, long-term holders have spent only 175,000 Bitcoin on net, demonstrating a remarkably resilient cohort of holders despite the prevailing macro headwinds. In summary, this week it appears that investors are deleveraging and utilising derivatives markets to hedge out risk and buy downside protection, with a keen eye on the Fed rate hikes expected in March. Meanwhile, overall, on-chain supply dynamics seem to be in the form of equilibrium. Both long and short-term holder supplies are range-bound. Minor balances are on an aggregate flat to slightly higher over the last few weeks, and whale supply, those with 100 to 10,000 BTC in their wallets, have been flat since December. Unlike previous Bitcoin cycles, the sale of spot holdings does not appear to be the preferred de-risking strategy. This reflects an increasingly mature market with a growing suite of derivative instruments available for risk managers. Isn't that great to see? As this industry matures further and further, we end up with more and more tools to make sure we don't take too much risk. And that's news for today. Jump over to ainsleywealth.com.au for all things cryptocurrency. You can buy, sell, and exchange. Did you know you can exchange for bullion through Ainsley Wealth? Something you can check out using our swap tool. Pretty fun little instrument there. AinsleyBullion.com.au if you're still after the physical stuff. Gold, silver, and platinum. And goldsilverstandard.com. That's our own cryptocurrency built and backed by real gold and silver. Enjoy your Tuesday, everyone. We'll catch you tomorrow for more news.